to HR Stock Street. In my first video, I had shown several criteria and parameters for trading a valid double bottom chart pattern. In case if you haven't seen the video, the link for the video is given in the description box, please watch. And those who have watched the video and have understood it, then you would have captured more than 200 points in Nifty on 3rd of February 2023. The long trade in Nifty perfectly mimicked the double bottom pattern discussed in my earlier video. A word of caution. This video helps you to acquire the skill of making an in-depth analysis of price action trading before jumping into a trade. Do not skip any part of the video. And don't forget to subscribe to my channel, and also hit the share and like button for this video. Let's look at the chart of Nifty on February 3rd, 2023, and how the day was set up for a double bottom pattern long trade. Firstly, we go into the higher time frame and mark the important resistance and supply zones. Here we see that the price fell sharply from two levels which can form as important supply zones. One is the level which is above the current market price, while the other level is the one which is near the current market price. Let's mark both the levels. To find out the precise supply zone, it appears to be little tricky. The entire zone from where the candle tails have been formed can be considered as supply zone. But for the purpose of intraday trade, let's mark the one closest to the current market price. Let's go back to the 5-minute time frame and find out if there are any zones of reversal in the previous day trading session. We can see that the supply zone, which was marked based on a doji candle in the 1HR time frame, appears to be the zone of reversal. Let's now mark the traditional levels that are important on the chart. The blue and red dotted lines indicate CPR, while the black dotted lines indicate previous day high and previous day low. The purple colored thick line indicate earlier monthly virgin CPR. Red dotted lines indicate resistance and green dotted lines indicate support levels. The yellow dotted lines are weekly CPR and the purple dotted lines are monthly CPR. You can get this indicator by selecting Pivot Boss Indicator by Samya Mitra. Let's begin the day's trading session. Though there is a good gap up opening, the open happened to be near the previous fresh resistance zone. So one can expect some selling to happen at these levels. You can see a black candle formation near the supply or resistance zone, but the close of the candle is above previous day high and also has formed a long tail rejection. Now we can see that the second 5-minute candle broke the initial opening range, showing bearish signs, but any short entry shall be taken once previous day high is broken. Here you can see that, though the open was above R1 resistance, the price could not sustain above and goes on to fall and close below it. This could be initial confirmation for downward movement. Now the price has broken below the previous day high and almost closed below it. This gives us the second indication that the price will move down. But one must be careful before taking a short trade. You should make sure that any short trade taken now must satisfy the risk-reward ratio of minimum 1:1.5. A short trade taken at current levels do not fit into the risk-reward ratio, and hence no short trade can be taken. In case if the price reaches my entry levels through a small pullback, then only a short trade will be executed. As the CPR and the zone of reversal are together, they can form a strong support. So till these two levels are broken, it cannot be said that the price is going to fall. Now you can see that the target has been hit and the short trade is closed with a profit. Now sit back and watch the price action near the CPR and the previous day zone of reversal. You can see a huge bullish engulfing candle near the CPR, and the volume on the candle seems to be more than the volumes of the previous 14 candles. But still there is no confirmation that the price will be going up any soon. Traders who trade using only candlestick pattern may succeed only 43% of the times or less, according to Thomas N. Gulwowski, the author of the book Encyclopedia of Candlestick Patterns. Hence, if you want to sustain in trading in stock market for longer period, one has to avoid trading candlestick pattern in isolation. Let's sit back and observe the price action. Here it is. We have identified the change in the direction of the price. The rejection candles formed near the CPR could not break the levels set by the previous bullish engulfing candles, and thus formed higher lows near the CPR. The rejection candles, were followed by a huge bullish candle, and the volume on this candle seems to be higher than the volumes of the previous 8 to 10 candles. Hence this appears to be the beginning of a double bottom pattern. A long trade can be entered here with single lot, and second lot can be taken once the neckline formed here is broken. One more important observation that a trader should make here is, observe the volumes on the black bearish candles formed recently. The volumes on them are lower than the volumes present in the white bullish candles. This shows that the buyers are more active than the sellers. Now that the neckline is broken, you can enter into the trade, with all the lots as per your risk management, and wait for the price to hit your target. Now that the target has been hit, you can either exit the trade or try trail your profits based on the 21 period EMA. You can exit all your positions at 3 p.m. and cherish the success of the trade. Hope you have enjoyed the video. And tip for molding yourself into a healthy trader: do not trade any signals in isolation, always look for confluence of multiple signals. This way you can reduce your losing trades to bare minimum. See you all, until next time.